There was a time, not too long ago, when the world seemed to go mad. Prices for a new kind of asset, one that didn't produce anything, didn't yield dividends, on its own had no intrinsic value. It began to rise, slowly at first, but then everything changed. What started out as a curiosity became a global sensation. People from every walk of life wanted it. This asset wasn't just for the wealthy or well-connected. Farmers, tradesmen, business owners, everyone saw an opportunity. It didn't matter if they had to sell off their property, mortgage their homes, or go into debt. The chance to own a piece of this new phenomenon was too tempting to pass up. Week after week, prices rose. People were doubling, tripling, or even quadrupling their money. A fever swept the market. Conversations around town and in bars were filled with speculation, tales of overnight riches, and wild predictions that this new asset could only go higher and higher. It was like everyone was convinced they'd unlock the secrets to newfound riches. But beneath the excitement, there were those who wondered, what is this thing really worth? People questioned how a market could be driven by something that, in truth, had no inherent utility or lasting value. Then it happened. Almost overnight, the frenzy turned to fear. Prices plummeted, fortunes vanished, and what once felt like a golden ticket now seemed like a foolish gamble. Those who had risked it all were left with nothing but shattered dreams and heavy debts. Now, this isn't the story of Bitcoin. It's the story of Tulip Mania, the very first financial bubble that gripped the world. And while the names may have changed, the psychology behind it remains eerily the same. I'm Noel Lorenzana, and many years ago I stumbled upon a book that changed how I view the world of finance. It's called Extraordinary Popular Delusions and the Madness of Crowds by Charles Mackay. It was published in 1841. It was as fascinating then as it is today. Mackay's insights on financial bubbles and crowd psychology have stood the test of time. And I think there's no better way to understand the frenzy surrounding Bitcoin than through the lens of this classic work. Charles Mackay observed how crowds often abandon reason in favor of popular opinion, and his descriptions of financial bubbles feel strangely familiar in today's world. This story may feel like a relic of the past, but the truth is, human psychology hasn't changed much since the days of Tulip Mania. Charles Mackay was a Scottish journalist and social observer. He captured the essence of this madness in his timeless work, Extraordinary Popular Delusions and the Madness of Crowds. Published nearly 2 centuries ago, Mackay's book examined how large groups of people can fall under the spell of a collective delusion. Mackay observed that once the crowd adopts an idea, rationality seems to vanish. Excitement builds up, emotions take over, and one by one, people lose themselves in the frenzy. Mackay described how bubbles don't begin with mania. They start out quietly, with just a few people curious enough to buy in. As prices rise, more people take notice. At first, it's just early adopters who see opportunity, but soon, it's the masses who jump in. The ones with little to no experience, believing they've found a sure path to wealth. Mackay explained that in the throes of a bubble, people stop asking questions about real value. Instead, they believe the hype, trusting that what's popular and increasing in price must be valuable. And it's only after the crash that the madness of crowds becomes clear. So is it really any different today? Bitcoin has captured the public imagination much like tulips did centuries ago. Only this time, the asset isn't a flower, it's a digital coin. But the mania, the psychology, it's exactly the same. Now that we know Mackay's framework, let's look at Bitcoin. Just like with Tulip Mania, Bitcoin's journey started out quietly. At first, only a handful of tech enthusiasts, libertarians, and early adopters took notice. It was a fringe idea in the beginning, something only a few believed in. But as Bitcoin's value climbed, the word started spreading. Investors saw profit potential, and the buzz began. Soon, financial experts, celebrities, and even major corporations were all weighing in, fueling public interest. Suddenly, Bitcoin wasn't just an asset, it was a movement. It was the future of money. Mackay might have called this point where the crowd goes mad. Social media and news outlets echoed Bitcoin's success stories, amplifying the excitement. People who had never invested before rushed in, many taking on debt to buy in, convinced they were witnessing the dawn of a new financial era. But as Mackay noted, bubbles are driven by the belief that prices can only go up. But in reality, no asset is immune to volatility. Bitcoin's history has been marked by extreme highs and devastating crashes, yet each time the price rebounded, the belief grew stronger, solidifying its status as the new digital gold. Mackay observed that in every bubble, there's a point where caution is abandoned. In the case of Bitcoin, critics raised concerns. Is it truly valuable? Or is it simply driven by speculative enthusiasm? Despite these concerns, Bitcoin's supporters view it as a revolution rather than a risk. Mackay reminds us that speculative manias often blur the line between innovation and illusion. While Bitcoin's technology may hold promise, the psychology behind its price might feel a little all too familiar. Bitcoin may be the latest and largest bubble we've seen, but it's not the only one. History shows us that whenever a new opportunity promises quick wealth, a frenzy often follows. As Mackay demonstrated, bubbles don't belong to any one era. They're a recurring feature of human behavior. And they're not always about flowers or coins. We've seen these manias unfold in our own time. Take the dot-com bubble of the late 1990s. New technology companies promised a future connected by the internet, and investors just couldn't resist. Tech stocks soared as money poured into companies with little more than ideas. When the bubble finally burst, trillions of dollars vanished overnight, and countless people lost their savings, myself included. The housing bubble of the 2000s is another example. Fueled by easy credit and the belief that housing prices could only go up, people rushed to buy homes and take on risky loans. When reality set in, the collapse rippled across the globe, leading to the Great Recession and financial hardship for millions. Even in the last few years, we've seen smaller bubbles take shape in unexpected places. Meme stocks like GameStop and AMC skyrocketed overnight, driven by online communities and the desire to cash in quickly. But like every bubble, these stocks eventually fell back to earth, and many small investors were left holding the bag. These modern bubbles remind us of one simple truth. When people see an opportunity for quick wealth, the temptation to follow the crowd can be overwhelming. Mackay understood that this madness of crowds isn't just a phenomenon of his time, it's a part of human nature. So where does Bitcoin fit into this story? Is it truly different from these past manias, or is it just the latest chapter of a long history of speculative bubbles? To answer that, let's look at Bitcoin's rise and the psychology behind it through Charles Mackay's historical lens. Bitcoin isn't just any asset. Its technology is revolutionary. It offers decentralized finance, a hedge against inflation, and for many, a vision of economic freedom. But even with all of this potential, Mackay's observations on speculative bubbles still ring true. Mackay taught us that bubbles often grow from something real, a new technology, a rare asset, or a breakthrough idea. In Bitcoin's case, blockchain technology has undeniable value, but as with any promising idea, when hype outweighs fundamentals, speculation can take control. Many investors see Bitcoin as a new digital gold, a store of value in a digital world. Yet like the tulips of 17th century Holland, Bitcoin's value is largely driven by belief, by the collective confidence that it's actually worth something. And that's exactly how bubbles form, when people invest based on sentiment and not fundamentals. As Mackay observed, crowd psychology fuels manias. With Bitcoin, the excitement has created a sense of urgency. Social media amplifies this, with everyone from tech influencers to celebrities hyping its potential. And with every upward spike, FOMO, the fear of missing out, pushes more people into the market, driving the prices up even further. Mackay warned us that the true test of an asset value comes during a crash. Like the South Sea bubble or the housing market, bubbles look unbreakable until they aren't. And when prices finally fall, only then do investors realize how much of their belief was based on hope, not substance. So is Bitcoin truly different, or is it simply the latest chapter in the long history of financial manias? Mackay's work reminds us that excitement and potential are not guarantees of stability. While Bitcoin and blockchain technology may change the world, we need to understand the risks beyond the hype. Now, before you conclude that I just don't understand Bitcoin, well, I do. In fact, I bought Bitcoin back in 2015 when it was only a couple $100s, long before most people even knew about it. Just take a look at these screenshots from my old Coinbase account. I even encouraged some close friends to get on it, and yes, I've since sold it, but back then, nobody knew what the heck I was even talking about. History doesn't predict the future, but it does show us patterns. And as we've seen, the names may change, but the manias remain the same. I'd love to hear your thoughts. Do you think Bitcoin is just another hype mania, or am I someone who just doesn't fully understand Bitcoin? Let me know in the comments below. If you found this video insightful, please do me a favor and give the video a like and consider subscribing to stay connected. Thank you so much for watching, and see you in another video.